Welcome back. Markets taking a break from their recent run-up at the end of last week. The major indices all lower. Take a look. As you see, Dow Industrials now at 26,447. This morning, we're taking a look at weakness at the open as well. We are expecting a decline right out of the gate of about 100 points, down 1/3% on the Dow, about 0.5% lower on the NASDAQ, 30 points lower. Joining us right now is Potomac Wealth Advisors President and Founder Mark Avallone. Mark, good to see you. Thanks very much for weighing in here. Your take on markets today going into the third quarter earnings season. We'll start with the banks on Friday, which, of course, will unleash a lot of earnings.
Well, it's important to remember about bank stocks. What really drives them to the downside are credit risk, loan loss reserves increasing, and that's the result of a bad economy. None of that is happening right now. You couple their strong balance sheets, the strong credit market, the demand for credit, the quality of credit, with the impact of the tax cut, and now these rising rates, and you have three factors why the financial sector and banks in particular are poised to report strong earnings. So I think banks might be a leader here and correct us from that little blip we saw last week.
Yeah, we are expecting 22% profit growth for the quarter. But then again, interest rates were really the story this past week. The 10-year Treasury yield hitting a 7-year high on Friday, up to 3.27%. Bond market is closed for Columbus Day today. But Dagan, what did you make of all those moves in interest rates last week and this concern about rising rates cutting into economic growth?
Well, this is good news for savers, number one, who have gotten the stick to not use an expletive over the last literally decade. Number one. Number two, that there's a certain healthy level of longer-term interest rates and a necessary pullback. But once we get into earnings season, you get the focus off of the higher rates and onto the incredible profit growth.
Yeah, just to double down on your point, we have an aging population in this country who rely on fixed income. So as they're getting older, higher interest rates are not a bad thing for the savers and the people who rely on fixed income.
Mark, you worried about higher rates?
I'm worried about the rapid pace of increase to rates, not the absolute levels. If you look historically, when the 10-year is below 4.5%, the stock market is in rally mode. What caused concern last week and last month is we had about a 40 basis point increase in the 10-year over a 30-day period. That's a concern. But if rates can calm down a little, I think the stock market can absorb interest rates at this level.
Is there a level at which, I mean, I've heard a lot of analysts say 3.5 and some have said 4, but is there a level at which the 10-year gets to a point where you start to see money managers rotate away from perhaps dividend-paying stocks and some other equities towards treasuries?
Well, I think we're a little bit away from there, but I do think, even though historically it was around 4.5%, once we cross over 4, I think you're going to see skittish investors start to take those concerns to heart. Remember, rates were so low, so they were historically low. I think when they jump up to 4%, those yields are going to look fat and juicy to some investors, and I think people who are cautious with the market right now might use that as a jumping-off point.
So you're somewhat, I mean, it sounds like you're somewhat cautious, but then I've heard some folks over who are much more pessimistic than you even sound, who are saying that the fundamentals just really are being inflated right now. All these numbers aren't necessarily there, that things are going to downturn. How do you reply to that? Are you more, or just how do you respond to that?
Well, this market's climbed a wall of worry for almost 10 years. I haven't heard people click their heels and say how great things were for a while. It's always been a risk out there and a headline fear. I think when you take away all the noise and you look at this strong earnings growth, you look at the impact of the tax cut, the super strong job market, you see fundamentals for the U.S. economy that are in place to continue this rally. There are headline risks, but I think most of those are overseas or with the Fed. They're not with the underlying economy. So if investors just keep their eye on corporate earnings, which is the #1 driver for stock prices, I think this rally has room to run at least through the end of the year, if not into 2019.
If you hear that from a